Hey everyone, today I'm extremely excited to talk about four of the best Dividend King stocks available to buy in the market today. So, for those of you who don't know, a Dividend King is a company who has not only paid out their dividend for 50 consecutive years, that's 200 consecutive quarters, but these businesses have actually increased their dividend for 50 straight years. Just think about that. Since the early 1970s or earlier, in lots of cases for these companies, no matter what's going on in the world, high inflation, recessions, other crises, macroeconomic issues, they have still increased their dividend year over year over year based off of their business model, their capital allocation strategy. So these are relatively defensive companies that if you're maybe looking for a company to grow yield over time, or just a company that tends to be a bit safe, likely won't go bankrupt from under your feet. These are companies that you may want to take a closer look at, get some exposure to one of them, depending on what kind of tools you're looking to build your portfolio with. If you haven't subscribed to the channel yet, please consider subscribing. We talk about a lot of stocks, portfolio management, earnings releases, just general business news. Would love to have you guys as part of the community, and would love to hear from you guys in the comments as well on any of these stocks if you've looked into them or you have other good dividend king stocks that you prefer to these, because there's not a ton of them out there, but more than four out there in the U.S. market. Okay, so we're gonna just jump right into it. The first Dividend King I want to talk about today is Genuine Parts Company. So, at a corporate level, this company's had a really good last year. Once again, these companies tend to be a bit more defensive. So, when the market goes down a lot, they tend to outperform. Maybe if the market has a really strong year, they underperform. But in the last year, this company has crushed the market. Markets probably down 15% over the last year. They're up 25%. So you can see that's a huge delta. So congratulations to anyone who has a good stake in Genuine Parts. They've done really well. If you look at their PE, they're about a 20x. They pay over a 2% dividend. So, you know, average value in terms of like a total price to earnings relative to the market, which isn't bad, but that just depends on the type of business they're in. I think with Genuine Parts, they do service a lot of cars and the automotive industry, and lots of people don't know where that industry is going. Is it moving more to electric vehicles? Will Tesla kind of not, or Tesla or other EVs not need the same kind of support from a parts perspective as the current car market does? And I feel like that's enabled this category to remain pretty low on stocks. That's really helped their buybacks go farther and have a higher return on invested capital and so on and so forth. So we'll see how that plays out long term. But over the last 50, 60 years, you can't really argue with the results. Going into the company a little bit more, you kind of have the 100-year history. So Napa Auto, established 1925. Throughout the last 100 years, they've had a lot of big acquisitions. They've gone public, and you kind of see what I find really interesting here in the top right-hand corner is just to show how resilient this company is. So in a 94-year history, they've increased sales and profit 80. So sales 88 times and profit 77 times. So sales have increased 88 times in the last 94 years. That means there's only 6 years in the last 100 years almost that they haven't been able to grow sales, and that's through, like the Great Recession, the Depression, lots of other huge issues, world wars, so on and so forth. So that's really impressive and really speaks to how strong their business model must be and how sticky their business is where they play. The other thing here that you'll see is not only is this a Dividend King who's increased their dividend for 50 straight years, but they've actually increased their dividend for 66 straight years. So you can sleep pretty well at night knowing that this buy-in yield of 2.1% is just going to go up and up and up and up. And you kind of get a sense for their growth rates Not crazy, but I wouldn't expect crazy growth from a 100-year-old company, but definitely not anything to dismiss either. Mid single digit revenue growth, high single digit EBITDA growth over the medium term here, past 10 years. So they've continued to perform really well, even in recent time periods. Looking at their business a bit, some of the brands that they own and how they operate. So obviously, very global company. You can kind of see here they have 22% of their business in Europe, 12% in Australia and Asia, 2/3 in the US. So maybe not very global, but they do have some global exposure. They have a lot of partnerships with big brands and big businesses across the automotive industry in terms of distribution and other means. So you kind of get a good sense for how they're really well integrated into the automotive space, across vectors and across segments. When you're talking about companies who've compounded growth and dividends over the course of half a century or more, what's really important to look at lots of the time is their capital allocation strategy and how are they taking their fuel, for lack of a better term, no pun intended, and using it to ensure they're future proofing their dividend growth into the future. And you can kind of get a good sense of what a good capital allocator does with the objective of having sustainable dividend growth. So obviously, first and foremost, they look at how can we reinvest in the business. So projected reinvestment of $350 million. Hopefully that's all they think they need, but that's under 20% of their cash flows. So they don't have like super high capex or a huge need for capital on the business, and they think they can keep running the business very efficiently. So that's one of the key things that really helps them to get set up for long-term dividend growth. And you've seen that play out over the last 50 years, because that means they have 80% of their profits to do other kinds of value creation investments to increase their profit numbers to pay higher dividends. So the first thing obviously is M&A. You kind of saw on that chart, they've done a lot of strategic acquisitions over the years. You get the immediate margin and profit that those companies bring in, but over time you also drive incremental synergies to make those businesses more profitable, scale your operation and your accounting team, your HR team, so on and so forth across more business. So over time, over the last 5 years, 1/3 of capital has gone to building the business through M&A. 13% has gone through share repurchases. So share repurchases is the obvious one that immediately provides some value back to shareholders and also enables the ability to increase the dividend per share because there's less dividends being or less shares to pay dividends to. But it's really interesting how they haven't really taken that one-to-one trade very often. Maybe they strategically jump in when they think the stock's cheap to increase their return on investment, or maybe they've just seen better return opportunities on M&A or internal reinvestment. But lots of the times you'll see even more than 13% of capital go towards share repurchases, because just to talk it out, if you have 100 shares and you're paying $100 million, that's $1 million per shareholder. But if you buy back 10 shares and you still just pay out $100 million, now each shareholder is getting 1.1 million, 1.11 million. So you can increase your dividend every year without necessarily increasing profits. And it seems like while they are decreasing the share count to have that element to the equation, for the most part, they're focused on profit driving activity with M&A and reinvestment to accelerate growth. So that's definitely a noble trait to have. They're not doing too much financial engineering here in terms of just buybacks to drive dividend growth. And then I guess, okay, this is just the say, I thought that was an EPS number, but this is their last raise. So 10% dividend raise, that's a pretty notable increase. So nice to see that these aren't these dinky 1% raises. They're really giving you real raises in line or ahead of inflation, which is great. just a chart here. You can kind of see how consistent. Used to be 23 cents in the early 80s, up over 1,000% to 326. So when you look at that starting dividend yield of 2.1%, if it was 2.1% 40 years ago, now it would be 15 times that. So it'd be 30% yield on cost. So hypothetically, if this scenario played out again and you bought this stock when you were in your early 20s, now you're in your mid 60s, you're pretty much generating, even without reinvestment over that time period, 30% yield on cost every year that you invested in your 20s. So you kind of see the long-term compounding effect of a business like this. Moving on to stock number 3, Procter and Gamble. So Procter and Gamble has a bit of a richer valuation, probably a bit less concern in terms of the arena they play in, being fast-moving consumer goods. So you kind of see them trading in about a mid-20 PE multiple, paying a dividend of about 2.6%. So looks like they're paying out close to 60-70% payout ratio versus the first company that we looked at that was closer to 50%. But they also have a really good track record that we'll go into in a minute. In terms of the background here, this is a company that is also defensive in nature, plays across lots of different categories that people use every day, lots of household brands across lots of different markets around the world, pretty global company as well. So the more diversified a business is and the more they play in things like consumer staples, the less they get hurt in cyclical times. And that really enables companies not to have to cut their dividend or not be under so much pressure that they can't increase their dividend or have a capital allocation strategy that they need to pivot away from growth objectives like we saw on one of those last slides. So this is definitely a business, while they are very closely tied to the consumer, they could definitely see impact overall on their business in hard times. Generally speaking, they're playing in areas that are likely not to decline too much over the short to medium term, and over the long term, well positioned to grow with the economy. So P&G called out here, they've grown their dividend 66 straight years. They did a 5% increase. So once again, maybe not as strong as that 10% increase we saw on the last name. But still, we're not talking 1-2% dividend increases here. I think they did a 10% 1 year ago as well. So we're talking about mid to high single digits. They're still cranking out, even in the 66th year of increases. So we won't play out the math on each of these, but you can kind of get the sense. Like, if you buy in today at a 2.6% dividend yield, if the dividend grows to the same extent as it has over the last decade, that dividend would be like 4 to 5% 10 years from now. And then you can keep compounding that over 20 years, 30 years, 40 years. So that's really the power of these. If you have a long-term investment horizon, you're looking for a safe company to build yield on cost over time. That's really where Dividend Kings come to play. They're not going to be the cheapest stocks because they've proven themselves, and they tend to be in defensive industries with great business models. So you have to pay up for them. Lots of people may not like that and veer away from them. That's fine. But I think for some investors, they definitely play a role. Okay, going into stock number 2. So second last stock here today in the top 4 that I've outlined is Johnson & Johnson. So another, let's call it consumer-facing company, but they have a lot of business units that we'll go into in a minute. Trading, I think they trade a bit cheaper than this, maybe some accounting going on, but I thought they traded about a 20x, give or take, price to earnings, paying a bit of a higher dividend than P&G at 2.8% instead of 2.6%. And this is a company that over the last year, they've been trading pretty flat. They've gone up a bit, down a bit, up a bit, back down a bit, but overall pretty flat. If you look at the long-term horizons of these companies, in a time period where they've been trending down, it tends to be a good opportunity to consider evaluating them for an entry point. In terms of their business, they have a great business. So you can kind of see on the left-hand side here, 3 business units: consumer health, pharmaceutical, and med tech. their pharmaceutical business is over 50% of their sales. So you're investing in a pharma company, but then they also have some consumer health to, um, you know, soften the volatility of the business, and some med tech as well, that they have exposure to. So if you look over here, they have 29 different products or platforms that generate over $1 billion in annual sales. Consumer health is probably the easiest one to understand. I'm sure we're all aware of some of these brands. Med tech, they're investing in different health segments. So knees, hips, trauma, energy. I'm not exactly sure how they bring this to life, to be honest, but is definitely an area of the company that at least differentiates them from some other big pharma companies. But then the bulk of the business here in pharma, I don't know a ton about these drugs. I'm not invested in the pharmaceutical space very much, but I just know I've seen some commercials for these, and that's about it. But you can kind of see over 60 years of consecutive dividend growth. Their earnings are very split between the US at the bottom here and international. So, very global company. Another element of diversification that enables them to continue to grow the dividend over time and not be weighed down if something huge happens in an economy to the downside, any particular economy that is. And even though we're on year 60, they keep increasing net earnings year over year. Earnings per share continue to trend up over time. So these are businesses similar to some of the other ones that we talked, that have really put up great business models around how they can continually grow and how they can invest for long-term growth in the segments they play in. And J&J is no different. So another great dividend king to consider looking into. Just a chart here over the last 50 years. Once again, not going to do the math, but you guys can kind of get the sense that they just compound the cash payout so well. So even though it's a 2.7% dividend today, you can obviously get higher yields on the market, but this is an investment that you can feel good about going to bed at night, holding in your portfolio, knowing how well they've created shareholder value over the last century, and also know that over the years you're going to be building a higher and higher yield on cost. 2.7% today can very easily be 5% in 2032. So just keep that in mind when considering investments in these names. It's really, really a long-term play. And stock number one is Illinois Toolworks. So to be honest, guys, this was one that I had a bit of fun researching while doing this video. I was not aware of this company, which is surprising because it's actually over a $70 billion company, and it is a dividend king as well. So, you learn a lot doing some research for these videos, which is awesome as well. So I don't know a ton about this company, but they definitely play in a lot of really interesting and diversified spaces. They have 7 different operating segments. So right off the bat, they're extremely diversified in where they play and what they do, where they bring in their revenue. Automotive OEM, food equipment, test and measurement, and electronics. Each of them doing between $2 and $3 billion of revenue in 2021. Operating margins between, let's call it 20 and 30%, so pretty standard across those 3 segments. Then they're also between 1.7 and $2 billion in their division for welding, polymers and fluids, construction products, specialty products, and these all tend to have high 20% margins in terms of operations and operating margins. So they really play in a lot of different spaces. Looks like an extremely boring company, but lots of the times that's the great backdrop for a company that can deliver results over the long term, because it's not too many sexy startups coming in to take their business. Lots of these businesses have know-how over 50, 60, 70 years, really strong customer relationships, stuff like that. So this is a really interesting company. Looks like it trades expensive because of it. Currently only paying a 2.2% dividend, so similar to Genuine Parts, but may have a bit of a higher PE because investors may not see too much downside in terms of their operations, given where they play and how long they've played there. In terms of their performance and key performance indicators, really impressive results. And once again, haven't looked into them too much, but it looks like over the long term, um, they've already delivered and they plan to continue to deliver high single digit annual EPS growth. So that could really help fuel future strong dividend growth as well. High operating margins, not surprising based off of the charts we just saw. But this is really awesome. After tax return on invested capital of 40% is extremely high. So that kind of goes to show that they have a lot of opportunities to invest in. They're not going crazy and spending their profits chasing every idea. They're focused on the very high return on invested, the return on investment opportunities, and they're returning the rest to shareholders, being very lean with your money and only chasing opportunities that they have high conviction will create a lot of shareholder value. The rest is going into buybacks and dividend increases to go back to the share owners, which is great. And then another thing I find interesting, and it's probably behind both margin expansion, but partially share buybacks as well. Organic growth, low to mid single digits, but they're calling out EPS growth of high single digits to 10%. So the fact that they called it out as EPS and not profit makes me think that they are a heavy share buyback company. So a bit of financial engineering, but I don't hate to see it, especially when they are still investing some money back into the business at very high return on investments. So that's the video for today, guys. These are the 4 top Dividend King stocks that I found in the market. There's a lot more of them. I think Coca-Cola is a Dividend King. A couple other companies are getting there. There's probably another half dozen or so out there. So would love to hear if you guys are invested in any other Dividend King companies. If you have any thoughts on the Dividend Kings that I shared here today, I think these, while not as sexy as tech companies, and not saying an investor should have a huge part of their portfolio in it, but I think for younger investors with a long-term investment horizon, it would be prudent to have strong dividend growth, very defensive companies at least represent a small portion of your portfolio for you to grow that yield on cost over time, reinvest the dividends in different opportunities throughout the year, but then be left with a high cash flowing yield on cash equity in your portfolio 10, 20, 30 years down the line. But this is not investment advice, just what I would do if I was in that situation. I do not own ITW or Genuine Parts or J&J. I only own P&G off of this list. For those of you who've seen my portfolio reveal, you'd probably know that by now. But yeah, that's it for this video. I'd love to hear from you guys in the comments, and thank you guys so much for tuning in. If you haven't subscribed to the channel, please hit that subscribe button in the corner. And if you like this type of content, please let me know by giving the video a thumbs up. It would help me a lot. See you guys in the next one.